Welcome to Swimming with Allocators,
the VC podcast from the LP perspective,
with your hosts, Alexa Benz
and Ernest Sweat. You ready? Let's dive in.
Today's episode, we welcome super connector Grady Buchanan. He's the co-founder and managing director of the Wisconsin-based NVNG Investment Advisors. It's a venture capital fund to fund. Grady is a super connector you're going to love. He's an honest and candid guy. He's going to speak about his investment opportunities outside of Silicon Valley, how tailoring a fund of funds to local corporates' needs is a great approach, and tips on growing your network and venture. So with that, Grady, thanks for coming on the pod.
No, thank you guys. Big fan. Happy to be here.
So I want to start out with why become an LP? And how did it happen?
Yeah, so LP, limited partner, right? Because I didn't even know what it meant. So I was under the belief that venture funds, hedge fund managers, they all just invested their own money, right? Like, as dumb as that sounds, that's what I came out of school thinking. I went down to Chicago, and that's where I got my first kind of class into what an LP is, right? So I was in a pit of analysts. We were managing investment performance and risk tolerances based on our clients' needs. One of the clients happened to be the Wisconsin Alumni Research Foundation. So they're like, Grady, you went to Madison, we'll give you this client. Great. Nothing other than that, other than luck, timing being there. That client was open. The analyst was transitioning, got one of the Madison endowments, of which there are two. So uniquely, this one was the tech transfer office. And I'll tell a little bit about that story because that's the group that I joined. And so everyone in our pit of analysts down in Chicago and Northern Trust, great program they have there. A lot of hedge funds come through, a lot of venture managers come through. So you kind of get to hear that side of the table as a true limited partner and try to relay that to your clients. And so in doing that, I was like, this is an interesting side of the table to be on. WARF, the Wisconsin Alumni Research Foundation, was doing very interesting things, awarded an innovation for their portfolio. My partner today was the chief investment officer when I joined. And so got the call to come up there. Didn't think I was going to go back to Madison and be a limited partner because I had gone to school there and probably saw a little bit too much and didn't know how adults were functioning there. A very big college town, right? But there was a lot going on. The investment portfolio and the mission attached to it and the team were very attractive to me. But that, to make a long answer short, is you're a limited partner now. Like, this is what the endowment does. You're on a team of 8 people. We have holistic asset allocation. We have the investment committee like everyone else. We do this annually. We look at every fund manager out there, which piece of the portfolio is right for you. I started in hedge funds and in our portable alpha strategy, which was complicated, right? But at some level, hedge funds, very, very different than venture capital managers. We're all investing dollars, but I quickly gravitated more toward venture. And so both sides of that, LP through and through.
And a common thing you hear is that, VC is an apprentice-based business. Would you say, you're now working with your old boss from WARF? Like, what's your advice there for people getting started as allocators too on, how to find those advocates or how to find those people that are going to take you along?
Sure. I started when I was at WARF. I probably had 0 LinkedIn connections, right? Didn't really focus on network, kind of really focused on, like most kids out of school, right? Or early in their careers, really focused on doing the job really well and then making sure that my performance reviews went well. And that's like important for like the manager that I had and no one else other than me, right? But at the institutional investment office that I was in, I had great mentors. Ryan, our hedge fund manager, John McCauley, who runs the Moat Foundation venture program now over in Michigan. And so they all landed very positively and they're all in different markets now, which is great. So I can still talk to them. And then Carrie was obviously kind of sitting at a higher level, reporting to the investment committee, kind of understanding what she did and being able to support her. But I don't know, I would say to the fund managers out there, it's like, it is a numbers game. If you wanted to get into venture, look up your job title. That's what I did. I was an investment analyst turned associate, portfolio managers, like put those job titles into LinkedIn and specifically into what you want to talk to. So I went to the Indiana Foundation or the Minnesota Foundation, started with the Big Ten schools, right? didn't know them from Adam, right? Like, it's like, oh, I don't really want to talk to Michigan because I went to school here, but I will talk to, because they have a very talented program and I'll get past it. And so, and then we could talk about sports and why they're better than us. So at some level, but it was interesting getting those connections, building those relationships, because they do things differently within different endowments. They'll know the same fund managers though. They'll have similar processes, different people, different strategies, different construction, but how do you guys do this? Like, what are you doing? What am I missing? Like, I'm brand new to this. Can you talk to us about it? And just building that network on the LP base.
What's a homeostasis private equity? Like obviously, I think all the GPs here are hoping to hear we've got tons of space. But can you sort of give us the flip side of like what is actually helpful as an LP if you're actually in a pretty good place and you've got your managers? Like, I think, like, how do you even recognize that an LP is in that space? What are the right questions to ask them?
LPs are they're challenging to work with sometimes because some are very heavy in venture. You won't know what their Excel models say. You won't really know what their DPI or their lack of distributions is right now. I think we're all in the same setting right now where everybody's waiting on distributions. Funds raised a little bit too quickly. Now they're all coming back to market. Large LPs, institutions, I don't think they care about that. They're going to sit there on the sidelines. They're going to wait. They'll flock more toward quality probably because those fund managers are in times that make more sense for them. But if you think about how they operate, you give them money back, they'll give them back to you. If we're sitting in a market that you're not delivering distributions, that's really tough for them to give you more dollars. So as a general partner just starting out, I'd really understand the market. I'd talk to other general partners and understand, like, all right, well, why are they one of your investors? Are we just taking anybody we can get, or is that a true partnership for you? What do they look at? Other GPs will be helpful.
Yeah. And what's the sort of basic strategy or day-to-day job of managing a venture portfolio that's in homeostasis?
If you're sitting in the homeostasis and your portfolio is looking great, you're not really going to churn managers. That's also a tough spot to be in if you're actually at the pension or an institution where I really like our managers. I'm not going to get rid of some of these, but we need some more capital to deploy. So what do we do here? Do we take some money down from some of the big ones? That's not going to be great. They're not going to like that because most of these institutions are very large. Or do we just divest entirely and not do the next fund and move it toward maybe a new class of managers and just kind of continue to build the portfolio that way? So it can be tough if you're in homeostasis where it is a competition game. Then it is an opportunity cost game where it's like we have 300 million in venture. It's all allocated. That doesn't mean we're not going to do new managers. It doesn't mean we're not going to right size this portfolio and construct it differently. But that's tough. That takes time. Like, so again, secondary market's big now. So that's helpful to some groups that want to get in and out of funds. But because you need liquidity. But other than that, it's you're still looking at new managers. I will say, like the institutions that we have, it's not like they're sitting there. It's like, oh, I'm done for the year. Like, good luck. They still have to be very conscious to what their portfolio is doing, which again is going to do what it's going to do with or without them. But then they have to know the new managers that are coming to market. They have to know the fund timing on their current managers and make sure that they're planned for that. So you're always still very busy. I don't actually like when people say it's like, oh, we're done allocating for the rest of the year. It's February. It's like, well, great. I don't know what you're going to do for 11 months. So, but they will tell that to GPs if they get a little bit, you realize you get them on a bad day. It's like, oh, geez, how many managers have reached out to you? But that happens. You will have LPs like that.
Grady, I've never asked anybody this on the pod, but a friend and a listener said I should. I feel like you're the perfect person. Do you think most LPs like their job?
Yeah. Well, I don't want to say anything out of turn.
We don't have to use this. We don't use this.
And I rarely.
No, it's okay.
No,
it's okay.
I'll say it, Ernest.
Okay.
No, I will say it. I love my job. I loved my job when I was at Wharf. I liked the LP setting. I liked having a mission behind what you were doing. And being able to give money back to the university that I was once a part of, right? That made sense. And helping like startups through the tech transfer office, that's kind of cool. Like it makes you feel good and doing well, but we're return seeking no matter what, right? And we always were. We believe that you can boost returns with some of the strategic initiatives that we do. But I don't know. I think a lot of LPs get, pick on institutions, paid very, very well. They have a very challenging job at times. And there's a lot of career risk there because you can be, I mean, you guys probably know, it's like, if you're right and with the crowd, great, big check mark. That's better than being wrong and against the crowd almost at times. It's like, because a lot of times you're not trying to set awards, you're not breaking records. If you're wrong and not with the crowd, you're fired, right? So like as an LP, that's very challenging. Your committee better have things in place for you to actually run with that autonomy if that's what you want to do. But if we put a portfolio together of 20 managers that nobody else is in and they fail, that's an easy thing for a large institutional LP to say no. So to that, what I mean is maybe you don't have autonomy to do exactly what you want to do. And I think that's to your question. Maybe you have investment committees that don't really see eye to eye with what your strategy is, and they just kind of want you to middle of the fairway it. And that can be boring for some folks that want to be truly innovative with their portfolios. So I'd say it's a good mix, but the LPs that we have and the LPs that we once were and the ones we choose to, it's like they've been the same. They seem to like their roles, mainly more Midwest driven, but overall, I hope so is the answer. But
me too. And so I want to kind of turn to NVNG, right? And so many times when someone like me talks to someone like you or another allocator, the question is, why do we need another Series A fund, or why do we need another seed fund, right? Walk me through why you felt we needed another fund of fund.
Why we need another fund of funds. NVNG, the reason why Carrie and I founded this and why we do it the way we do it, obviously you hear the history at Wharf, it's basically a fund of fund strategy. We had in venture, right? Like that's the institutional. And we had some co-investment that Carrie would run with Wharf because we had it was the tech transfer office, right? So you had things come through campus that needed some eyes and ears. Maybe we could directly invest alongside some of our managers. And in kind of sitting down with Carrie and asking about like, what should we do next? Like what makes sense? Michigan had one of these, right? And Renaissance Centrifuge has one in Ohio. HX has one down in Houston. They're fund of funds backed by corporate. So what we know how to do is pick managers, construct portfolios. It's what we built our careers on doing, can hit return targets. That part makes sense to us. That's like the financial nerdy part that not a lot of people care about, but that's what we know. And so it's like, okay, we had one investor in Wisconsin that happened to be the university. We did everything under the guise of we need to help the university. We have a spending report, we have a target, ventures part of the overall portfolio. But how do we use the venture portfolio strategically on campus? Because we could say no to everyone, and that's not that helpful. And if we like something, we're not that helpful. But some of these venture funds with corporate connections and ties out of market can be very helpful, physically located on campus. Mm-hmm. The assets that Wisconsin has, because we're in Wisconsin, we're not the startup hub. If we were the startup hub, you guys would know about it. We're not the venture capital hub. If we were the venture capital hub, you guys would know about it. What we do have, though, if you look at it, we're one of the biggest manufacturing corridors, if not the largest in the country. The Midwest thesis alone for us was something that we were really geared toward, kind of that whole American dynamism thing and whatever. But investing earlier into maybe some what we'd call Rust Belt offline companies that could really help shape corporations that are looking for this innovation. And the Wisconsin assets that we have, like I said, corporations. So if you look at it, it's not startups, it's not so much venture. We are trying hard in those spaces and our state efforts helping, but corporations are the big ones. It's like, all right, some of these surnames are massive. Some of these are global institutions with really big teams. They're working on innovative things. They have the right job titles. Our venture managers don't know how to connect into them, or very, very seldom do they, with very few of them. And it's like, these are massive organizations, like big. And they're really good at making things. So you have these corporations that are very large. They're trying to attach themselves to innovation. They're doing it very internally. They didn't have a fund like this. So again, we didn't have a fund of funds presence here. Very few were investing in venture funds. A lot of them were going direct in their M&A departments and family offices, like a lot of corporations do, but just no real ties to the venture community. And the answer to them is, well, why do we need this, right? So the sell on our side is, well, can we open up Wisconsin? Can we open up, and we say Wisconsin, but if you think about it, it's just Midwest exposure. The corporations that I listed, they could be in St. Louis. It's no real different. But we just happen to be in Wisconsin and we like it here. And if Carrie's going to be in Madison and I'm in Milwaukee, why don't we try to get not just the one investor, but a bunch of different limited partners, and a limited partners that are focused on, what's important to their corporations and their assets, but also limited partners that don't have exposure to the asset class that could, one, really benefit from the returns that we think we can provide, because again, financially driven first. But can these corporations lend value, insights, and their strategic use cases to the portfolio companies within these managers? Because rather than wait till they hit 100 million and let's all fight over the acquisition, what if you could help them pivot early? What if you could talk to them earlier? What if you could maybe pilot and provide that kind of early revenue to these companies with the incentive being you're an investor in the fund, right?
Awesome. How do you draw those connections for the startup founders to your LPs so that they can start having meaningful relationships?
Yes. So we guess, and then we just send emails. Well, for the most part, it's almost not that far off right now. So we started our first investment was in 2021. So that was the first close of Fund One, and we've been investing since. And as we put new managers in, we'll hold like kind of smaller webinars that teach our LPs, like we call them Meet the Managers. And we teach our LPs and we'll put on 1 or 2 or 3 managers based on the quarter. And it's like, just share what you're doing. It's almost like the fund manager pitch, same thing you guys could do, right? It's like, talk to the corporations that are here. We record it, we put it on a platform. We use Notion as our platform, Alexa, to directly answer your question. So it's login based. We struggle with finding the right people inside of corporations in which to send these companies, right? So like our investors are amazing, right? Like they're great corporations, but as you can imagine, some of those decisions were made from the top or made from somebody inside the organization that's managing it, that's in the financial side and they're not on the innovation side.
Yeah. No, I think it's a crazy challenge with companies that are just that big. A friend last night was telling me Walmart's put $20 million into his business and he's still, looking for those champions in different parts of the company. So I don't think it's layers. I don't think it's having the VC with the fund of funds. I think it's in general, these corporations are so big that it's tough to get to the right person that you really need to talk to if you've just been talking to corp finance or something.
Well, they're big and they move around too. People move. So like you could be like, think about a startup trying to sell into a large corporate here for 7 months. The sales motion's taking a long time. They got to pivot. Oh, our champion's great. This is going to get across the line. It's like, you email that champion, I'm no longer with the company. Thank you so much for whatever. It's like, oh shoot. Now, and that can happen to us too, right? So it's like, and we're cognizant to it. But that's where it is. It's like, can we create like a profile in ways where the corporation owns it and you can put different people in there, put interns in there, put new talent hires in there so they can see the innovation arm. But is there something there where it's a little bit, when I say sticky, it's sticky to regardless of the people that may be there, what's the innovation engine that you have and how do we tap into it?
Yeah. I remember when I was at Prologis and building out their venture practice and innovation practice, it was a challenge. And then also being able to connect not only other venture capitalists, but our startups, as well as connect to Prologis's customer base to then bring it the entire kind of network effects then become kind of like constellation effects, right? Where like, no matter where they are, there's a lot of like value being sent, right? It's just a tough thing. Now, does the value add influence your criteria of the type of fund managers you want? Like if somebody's good at that in navigating companies, does that influence?
Yes, it does. I ask if you can speak that corporate language. Do you guys have an interest in doing that? A lot of fund managers won't. Like a lot of them are skittish around like, I don't want to talk to any corporates. Like corporates are nightmares. It's like, well, okay, what if we sit in between? And I'm not saying talk to corporates as LPs. I'm saying talk to corporates so they can help your portfolio companies. That they're all very interested in, right? And so it's our job to suss out, like, because even if it's a software only 10 companies, it's like, oh, I have a really hard time believing that any of these early stage companies are going to get pilots or programs up in some of ours because they're already either doing it or there's a reason, whatever. But the GP will say, yeah, this is great. I want to tap into Wisconsin. We don't have any customers in the portfolio in Wisconsin. It's like, okay. So we've realized everyone's going to say yes to that. But as you diligence them, Ernest, to your question, and you talk to some of their corporates, do they have corporate LPs? Are they backed by families that have done things in the past, that have built things? Why is that family investing in you guys? And are they a manufacturer because you guys are all manufacturing technology? So we look at that, like make sure that the LPs are really core to, I mean, if you get a couple of LPs in their corporates, and this is one of the 2 or only funds that they picked in the supply chain sector, it's like that's probably a decent bet for us. because not for nothing in Wisconsin, they're not seeing what those LPs are seeing.
I want to hear a quick pitch on, you mentioned Centrifuge. We have Renaissance on, Christina came on the pod, and then HX. So I guess Centrifuge and HX, you're up next. But could you give a pitch for why this approach to having local corporate LPs is a better approach for states and regions than kind of doing the insular only state money and not looking to invest all over?
Yeah, and there does not seem to be a true in between. So like that's the battle that we fight too, where because we'll see startups around here and maybe they've taken some of the public dollars, right? And their cap tables look a little bit different. Like this is no offense toward the government. It's just it has to be structured and aligned with the rest of the private industry. And so a lot of the VCs, a lot of our industry get really like frustrated with seeing some of these things come out or like chasing problems that don't exist. Like we need a bunch more venture dollars in Wisconsin for all of our startups. Like show me all of our startups, tell me about where we need to be. And let's see if we can get outside venture here too. So I guess there's the local discount kind of game like that still exists. It's like, and I think some groups have done this really well. There's like a Tento in Oklahoma City. Like they care about Oklahoma City. They bring things there. Bentonville, everybody knows what's in Bentonville. And regardless of what they know, if they're investing into, it's like they're doing things in Bentonville, right? And they're bringing all these companies. So you can kind of see like they're trying to change place for the benefit of the larger organizations, for the benefit of people that want to live and work there, and promoting the fun aspects of things. And you can kind of do that through venture and startups, but like admittedly, and just not to be like super harsh on Milwaukee, but if you're a startup founder here, why would I live here and not Chicago? It's like, you better love Milwaukee, and the quality of life is like, it's the same. But I look at us as like, we're a Chicago suburb. Like people in Milwaukee might like hang me for this, but it's like, we are a Chicago North suburb, and I'd love it if Chicago included us. But we also have corporations that are much larger. We have corporations that are more powerful, and we're not competing over this region, or at least I don't want to. Wisconsin, we've had Madison. Madison's pretty good at healthcare. Like, you can guess why, right? Green Bay's manufacturing, and we got a big sports team up there, and they have a lot of supply chain, and healthcare is across the state. And then you got Milwaukee in manufacturing, and some other kind of nuanced sectors. But it's like, we're good at building things. We're decent at healthcare. Chicago's kind of the same. I don't know why everybody's different. Or it's like Cincinnati needs to do this. It's like, we're the same as Cincinnati. So when you kind of go across the Midwest, and what Carrie and I were built to do at Wharf, our networks lived elsewhere. Like, we weren't investing in venture funds right across the street because frankly, we didn't have any. If we had local funds, great, they'd be in the portfolio, but we had to expand the network. And the reasons we were investing in healthcare specific funds strategically is so they could get to campus, talk about some of the things that were going on. Now at NVNG, our LP base is kind of across the spectrum of sector in the Midwest. And I think the outside in approach is what we've tried to teach our LPs quite a bit. Outside in is in, this is how we were built. Like, if we were Silicon Valley and Milwaukee, you wouldn't need this fund of funds. That's pretty easy. Go pick the 10 best managers that you can get into, and we can help you with that. But we don't have any exposure here. What if you had a fund of funds manager that actually went out and found the Earnests, found the Alexas, and said, these are managers that are building and investing in certain markets. I don't necessarily care where based on geography, unless that's core to your mission. And you're only going to do things in Bentonville. Great. If we like Bentonville, that makes sense for us. But geography is not as important as it is the portfolio companies that you're attaching to and the founders that you're attracting. If the founders are all big in manufacturing, every spin out from any large manufacturer wants to go work at this venture fund and take their money. It's like, ooh, that's probably one we'd like to talk to. But from a private perspective, I mean, Wisconsin just deserved this exposure. We saw that corporations had it. Maybe some were talking to venture. We just frankly don't have a lot of large institutional LPs either. We have good campuses and universities that work for themselves, right? And that makes sense. But who's really going to open it up and build everything together when these large corporations are working in almost silos, specifically in venture? We're here in Wisconsin, so we care about it, but we just happen to be here. We're finding firms and companies that are relevant to here, wherever they may be.
Now we're going to take a quick break to speak with our sponsor.
On the show today, we have a friend and industry expert, Nick Talwar, fractional CTO for both VCs and their portcos. His agency, Bottega8, trains custom AI models for financial institutions like yours. Welcome, Nick. You know all these things about implementing AI into our funds and portfolio companies that we are eager to become experts at, so thank you. As a technical startup founder yourself, many times over, You're now in the weeds for a lot of different companies as a fractional CTO. And every VC and every LP is thinking about how should I be best investing in this space. Do you have an opinion on where we should or shouldn't be investing when it comes to AI?
Yes, that's a great question. I really boil it down to 3 heuristics. The first is technology moat. The second is AI first operations, which is often overlooked. And the third is AI expertise. So with the technology moat, it's really important that the deal you're looking at or the company you're looking at has proprietary data, but tied to unique human capital. And lastly, it's a vertical product. That's really important because a lot of horizontal products will get subsumed by large scale models like, from OpenAI, Microsoft, Anthropic, Meta, Google. And AI, when it's met with a vertical niche, is a pretty good bet. It'll just get better and better with tighter context over time with proprietary data that those big companies can't crawl. Second is like AI first operation. This is really overlooked. Like the whole nature of how a company does business in the last 2 years has changed dramatically. Like for example, we are 3 to 5x more efficient now because, over the last 18 months, I've looked at every single one of our business processes or engineering and product processes and made them AI first and AI native from the ground up. And it is just startling as to how much value we've been able to create through those efficiencies. And it's kind of freed up my time to just do what I do best. And you really need to take a look at the founders and make sure that they are looking at their operations, are willing to learn, roll up their sleeves, and actually use these new tools. And not just oh, I subscribe to free ChatGPT, I just talk to it sometimes. No, it needs to be a little bit deeper than that, particularly when it comes to operations. And then as a corollary, bootstrappers. There's so many great bootstrappers right now that have built a micro SaaS and using AI first native tools. Perhaps they have like a Fire TikTok channel, right? And those people are so well suited to be founders. If I was like a VC today, I'd be encouraging them to take a niche and partnering with you if you're an early seed stage fund to kind of nurture them and even cross-pollinate what they've done across your portcos. And then lastly, it's true AI expertise. Mm-hmm. I see this a lot. 20 years ago, I'm dating myself, but 20 years ago in college, I studied neural networks. And that's the foundation of AI and deep learning. Yes, the Transformers paper was a seminal moment 5-6 years ago, and it changed and led to ChatGPT 3.5. But true AI expertise, everyone's putting AI in front of their name, and you have to really vet that the CTO or the co-founder that's in charge of the technology actually is an AI expert, because most of these products will just fall flat. So the best AI engineers have been in the space for a while. They understand machine learning and they understand data engineering, which is the core to making AI work well. So those are the 3 things I would look at.
Oh man, exceptionally helpful, particularly for our LPs who are trusting the GPs are doing a good job of filtering to know if they're bringing them the right stuff. You are the expert now on helping executives understand how to implement AI in their company. And I'm curious, what do these execs generally get wrong about implementing AI?
Yeah, I love this question. I fell into writing an AI executive curriculum as I got tired of the mismatch between the public AI marketing conversation and what we were seeing on the ground with VCs and companies. There was such a disconnect. And so it boils down to a few important things. Your data story and your company culture. And again, the company culture is often overlooked, which is really important. So AI isn't plug and play. It requires deep data prep. You need clean, well-structured data to be successful. It's also very multidisciplinary. Your product, engineering, and sales and customer success at a company needs to all work in tandem and develop new collaborative frameworks that are AI first to make sure that your product is on the right track. And AI breaks down these walls, and it does that by definition. And in my AI Playbook for Execs, we talk about creating a shared AI workspace. Because a big problem we have is back in the day, we would have a web app and we would have a Figma of here's what we're building as a team. And then we'd go rah, company all hands, this is the entire UX, and we're going to hopefully do it iteratively. and not be waterfall, but like we're going to be agile and make this happen. And that doesn't really exist for AI. Like data is, ephemeral. And right, so creating that AI workspace is actually the new mock-up. And that's one of the key things we've developed as a framework in that playbook. And most don't heed like this advice. And so they just get started with an API integration and it falls flat. And usually I get a phone call, a year later saying they've made no progress, right? And that's always really sad. And I'd like to, your listeners to avoid that fate. And the second piece is like culture. Keep in mind employees have been assaulted with doom and gloom. AI will take our jobs. Like really empathize with your people. It's like marketing from all angles. And that's very self-serving from big tech, right? They want you to think that so you'll use their products, right? Yeah. And you have to manage expectations and assuage concerns. Otherwise, it's going to torpedo your culture. People will leave. It'll devolve into politics and bureaucracy. Most don't heed this advice. And that's why it's, step 2 in our playbook. Like people wonder why their first AI project gets mired in back and forth. Yeah. I've seen this story a couple of times already. And, it's just a confusing time. I see this when I do our technical due diligence or doc review of a company. They misuse basic AI terminology. So investing in learning and develop is super important. Like you need to know the differences between like machine learning and deep learning and an LLM versus generative AI. Like these are basic terms that people toss around very willy-nilly, and it really frustrates me, as that sort of engineer type person that's like, what are we really talking about here?
Yeah, AI washing as opposed to...
Exactly. Just throw it in the washing machine, throw some terms on it, sprinkle some fairy dust, it'll work, right? But no, it's not really how it works. And then at the core of it, people have they think that AI is like an all-knowing bot, right? Like the movies have conditioned us for decades. It's in the best interest of big tech and their APIs that we just go to them as the arbiter of knowledge for everything, as the oracle. And when the reality is that's not really how AI can help you today and in the future even, in my opinion. It works best as a context-oriented tactical bot for a back-end workflow. I'll say it again because it's so important. It's a context-oriented tactical bot for a back-end workflow. That's the real impact we're seeing today. It's not like a customer-facing chatbot has its limitation, and we never use that as a case study or example. And you can train multiple versions of a AI bot for different contexts, different teams, and different workflows to help you augment your work and make it more accurate and efficient. And you got to tailor to each use case. So long story short, a lot of things, but if you keep these few things in mind, I think you'll be really successful.
That's an awesome teaser of your AI playbook for execs. Obviously, we highly recommend it. Having been helping these people with change management, give you an opinion on whether the winners are going to be people who are building from the ground up, like you and your own agency, where you have been sort of AI first from the beginning, versus some of these challenges you're describing for existing companies. In the horse race of being AI enabled, are these newer firms and companies that are sort of AI native going to win?
Yes, I think they will. I mean, provided they're just not a ChatGPT wrapper, which we already saw that wave last year come and go. But I think, the nature of work, the future of work conversation that's been brewing for 10 years, it really, in the last 24 months has actually, hit the rubber meets the road.
Yeah.
And, the ZERP era is behind us. So OpEx has been the entire conversation for the last 36 months. And so AI does that. So, I think that story is writing itself.
Thank you so much, Nick. If you are looking for help implementing AI at your fund or across your portfolio, you can please go to bottega8.com/swimming. That's BOTTEGA 8 as in the number .com/swimming. We appreciate you giving us the credit, so please use the URL. And now back to our LP interview. The relevancy piece makes a lot of sense based on who your LPs are. What else makes a GP a good fit for you all?
Core fits for us, like from the onset, I need to know that there's a network there. I need to know that this brand is ready to attract institutional capital, or it's building a firm that will one day attract institutional capital because they're targeting venture capital competitive returns, because they're able to attract founders core to their sectors. So a lot of what we do ends up coming down to references, referrals, like calls around like the industry. We have the benefit of having corporate. So corporates get to lend their eyes and ears and saying, this is never going to work. Their fund doesn't work. Energy is never going to sell this way. It's like, well, that's okay. That's good to know. Like we can write that in and we can document it, go at it with the manager as to why they believe it or not at the corporate level. But we have, when we look at managers, like they better have that network, and because we're going to call them and we're going to figure it out. Venture capital is so transparent these days for any new managers. Just understand that, like, if you pull a term sheet, like, and the founder's upset, like, that's going to get back to an LP that's doing diligence on you. You better have a story around that. Like, I know everything's different. People pull term sheets. But again, everything's so transparent. Everyone's co-investing in very similar looking deals right now, especially in our space across like very core industry verticals. And so I would say that network is huge, building your brand, focusing on it, even in Fund 1 to attract founders. It's like, oh, you're going to be the best in manufacturing. It's like, well, how is your brand growing? Do founders know that about you? When they type it in on Google, when they talk to other founders, are they going to mention you guys? Because then you'll miss that deal flow if you're not focused on it. So again, the network, the brand, that's kind of more on the emerging side. Returns is the obvious answer when you look at kind of bigger managers that have been around. Can they prove results? But I inherently believe VC does three things. Like, you raise money, you invest in companies, and you have to exit companies, which returns money to the limited partners. If you can't do the first one, it doesn't really matter. So again, network is most important, making sure that they have their way to win within their strategy. And then our thing is that corporate angle. Like, it has to be kind of Midwest aligned, and it has to be ready to go into a corporation or one day want to go into a corporation here.
And is co-investment also something in consideration for you, whether you're going to direct or any of your corporates want to go direct?
Most of our funds will offer co-investment. They're very nice to us, and they'll offer it on our platform just to see what LPs that we have. NVNG itself in Fund 1, not interested in co-investment so much. We offered on the platform to our LPs. We actually don't do it ourselves. So it's kind of nice for our managers, because if we raise any money from our LPs, great, that's good for them. If we raise zero, great. They don't really care either way because they're doing their own sidecar vehicles. It is a good question, though, because managers that don't offer co-investment, why or why not? Who are their LPs going to be? Could it hurt them in the fundraise based on their strategies and how much they have reserved for or how much they're going to offer in co-investment? Or do they have proprietary co-investments that only go to the bigger LPs? Like, again, things that we don't necessarily care about as investors ourselves, but as managers and LPs in the fund, I need to make sure that they're set up to doing everything appropriately, not just for one LP or for two or three big ones, but for everyone in the fund. Make sure that they're scaling appropriately. So in future fundraises, that's cool. Maybe we do want to do the co-investment thing and we have access to it, but protecting other LP interests, it's not necessarily what we have to do, but it is something we look out for. And that co-investment piece is something that does help attract capital for these managers.
Grady, is there, I know in our prep call, we spoke about just what's out there in the market, 2,100 funds or whatever there is, and people in various stages, right? Emerging manager, established manager, going out to market. Could you talk to us about like kind of the trends you're seeing as far as like what's interesting, what's not interesting?
Yeah.
And what managers shouldn't be doing anymore?
Managers should not chase the shiny objects, no matter if you're emerging or well-established. And what I mean by shiny objects, it's actually the thing that we're attracted to right now because we're in the market. And so we're going to be deploying next year and things like that. So the shiny object today seems to be on trend is defense tech, very real companies that it could be software wrapped in hardware, but a lot of them are hardware companies. A lot of them are operators from large, call them corporations that are builders, and they're building real things, like very hardware specific things, very, very they almost look like private equity type companies, but they're still early. And this is the whole venture needs to go more toward the Midwest. Venture needs to hit up more of the American dynamism stuff that Mark and team preach. So, and that might be true. It's still very challenging for them. We have managers that are obviously writing checks in those spaces. Like that's how we pick our managers. But for a lot of other ones, it's like you can see that this is a trend because you can see some of the, I won't say their names, but let's call them Silicon Valley managers that oftentimes don't do a lot in the Midwest. You see them in early stage rounds. You see them buying optionality for the later rounds in which they'd probably invest. But they're finding companies.
Grady, it's been great having you on, and I was wondering if you had any kind of parting thoughts for our other allocators or our managers.
I would say the allocators, obviously look at a fund of funds is a great one based in Wisconsin that would love to talk to you about venture capital. But more realistically, if you're ready for general partners and emerging general partners or just general partners that are out there, maybe with new investor relations people, we hear a lot of the same things. Most GPs want to get to deal flow and ignore the fundraising relationship side of things, which I don't blame them. But it's important to pick your LP partners, and it's important to pick them in ways that help you build your firm if you're an emerging manager. And so, I don't know, we get enough emerging managers around here, and I will speak to every single one of them, sole GPs, like multiple teams, doesn't really matter. But if you come from a different world, if you're like, it's like, what did Peter Thiel say? Competition's for losers, right? It's like, I don't subscribe to that theory so much, but venture managers for us, fund of funds, institutions, especially in today's world with all these different managers, maybe that is the way to go. Like if you came to us and said like, we have a fund manager, sends us quarterly letters. I won't name him because he'll listen to this, I'm sure, but like no idea the types of companies he actually likes to invest into. I could not tell you like after the first like 10 investments, it's like, oh, this is what makes a good company. But what I can tell you is those 10 companies are totally different outside of anything else that our other 190 plus companies are in. Like, and so that's an interesting manager for us because they live in a different world, a very different type of strategy, and they're going to invest in companies that I might have no idea why, but that could be the next unicorn for all they believe, right? And so they're proving out that thesis. But that's an emerging manager fund one that we took a bet on because we knew that deal flow would be unique, also close to home. But yeah, I won't share the name.
No, that was a great, no, that makes sense. Thanks so much, Grady. We have to have you back on because I know you're going to have even more insights in a year or so, but thanks for being on some of the allocators.
No, thanks so much, guys. Happy to do it.
Thanks, Grady.
Bye.
See you later, allocator.
After Portfolio Tile, investing with a smile.